Hello, and welcome to episode 10 of the Income Tax and CCPC course. This is Module 7, and you are tuning into the Wild Bat podcast. Today, we're going to be discussing eligible dividend rules. This is where the income in the corporation is taxed not under the small business deduction. Sometimes the income is in excess of this in a CCPC, and it is also not aggregate investment income. As discussed in an earlier podcast, the dividends are grossed up, where eligible dividends are grossed up 38% and non-eligible dividends are grossed up 15%. The reason for this is the corporation receives the money and pays tax on the income or the net profits, and when it is declaring any dividends, these dividends are declared post-tax. So the corporation has already paid tax on this income, so we need to increase the income via a gross up in order to align the shareholder to pay tax on the gross up amount, which would represent the pre-tax profit. If you look at a T5 under box 24, you'll see the actual amount of dividends. This is what is reduced from your retained earnings in your corporation, and it would get grossed up 38% in box 25, which is what's going to be recognized on your T1 or at the T2 of a holding company. In order for the shareholder not to pay tax twice, we apply a dividend tax credit. The reason is to help with the alignment between corporation and shareholder, again, so that it is indifferent that the shareholder incorporates any profitable activity. So there is an integration with the gross up and the dividend tax credit. For example, in Alberta in 2021, a recipient corporation will receive a dividend tax credit for non-eligible dividends totaling 12.88% of the actual dividends paid. If it's an eligible dividend, however, it is even greater than this at 34.53%. Eligible dividends are represent income that is taxed at the full rate amount. It is not subject to the small business deduction, nor is it aggregate investment income in which there is a refundable tax component. This dividend has to be designated by the issuing corporation. It could include a deemed dividend in which the value of the shareholding, the book value of their shareholding has increased, but it would not include any capital dividends. You do not designate eligible dividends to non-resident recipients, and it must meet the requirements of Section 89, Part 14. This is where the corporation has to declare and notify the recipients that it is an eligible dividend. Public corporations have to make a public statement, and there has to be a suitable method for CCPCs to notify the concept that it is an eligible dividend and hence to be treated as such on their personal tax return. You never used to be able to do this before 2012 in Canada here, but you can split your dividend where there is an eligible and a non-eligible dividend component, which makes things a little simpler. And if you reassess your taxes, or you want to you want to create some tax planning, you can elect a late designation of up to 3 years after the first payment was made to change it from a eligible dividend to a non-eligible dividend, or vice versa. Now I'm going to shoot over to IVPost Scanner right now to discuss share class structure. Here we're going to look at the share class structure, which happens when a corporation starts its organization and starts issuing shares to whoever wants the shares, whoever the owners are. Now, what I learned, and what most of us probably learned in school, was that there's common shares which have voting rights, and the only ones that have voting rights, they get the residual dividends. Liquidation, they get the residual whatever's left under liquidation, and they have a limited liability. Preferred shares are like common shares, except they are a lower class, which have less risk because they get priority dividends and priority upon liquidation. They do not have voting rights, and obviously the liability is limited to the amount they have in their shareholding. Debt, on the other hand, is fixed. There are fixed interest payments which the corporation cannot get out of. Upon liquidation, they get first dibs on any assets that get sold off. They do not have any voting rights within the corporation, and the limit of liability. Well, they lose their loan, but they can't get sued or anything like that, unlike the corporation. However, that's in theory, and that's what we learn in school, but in practice it's a little bit different. As we're going to see later on, the dividend payments, well, this is actually the same. It is based on the declaration of the share class. Come down here. This is how a shareholder schedule will look. You'll have Class A shares that are common and voting, and then you'll have Class B shares which are common and non-voting. So this one here and this one here are a little bit different. You see, it depends on the class, and common shares can be non-voting, and preferred shares can be voting. Dividends as well. It depends on what class is issued a dividend. We could set up right here that Class A gets $100 per share, and then Class B gets $10,000 per share. And these guys get nothing, which is contradictory to what we learned in school, where preferred shares get priority over common shares. Another concept as well, before we wrap this one up, is that liquidation, yes, debt should have first priority over any equity holding. However, this sometimes doesn't happen. That happens more often than you think, where the shareholders will withdraw their money out of here, and there'll be nothing left for the bondholder. And sometimes more often than not, nothing ever gets done about it. The bondholder doesn't get anything, and they try and, they may try and sue, they may try and chase them up, but gets nothing. The limit of liability, again, is a little bit different. We learn that there's limited liability being a shareholder in a company. Now, that doesn't happen. What usually happens is the bondholder, the bank, or the institutional investor is not going to give a corporation funds unless the shareholder or the director guarantees the loan. And also, again, when it comes to voting rights, well, The bondholder may not get to say what happens in the corporation, but it definitely does put in some covenants to make sure that things do happen, such as certain profit times interest earned, and other covenants that may exist. Let's talk about the general rate income pool, or GRIP. This is a pool, a tax account that keeps track of the amount of general rate income, or income that is taxed outside of the small business deduction or aggregate investment income, and is retained and kept track of in the CRA and on your tax return under Schedule 53. Whatever is in this account can be allocated as eligible dividends. There is a bit of a complicated formula that we have to apply, so please bear with me. The basic part of the formula is this: A minus B equals GRIP. And we've got to figure out, B is very simple, it's this part here. A, however, is all of this here that we have to calculate. Another way of looking at it, which is how I've displayed it here, is C plus D plus E plus F minus G, and then minus B equals our GRIP balance. Let's start off with C. C is the GRIP at the end of the prior year. D is 72%, or the general rate factor of the full rate taxable income. E is the total eligible dividends received from other corporations. F is any GRIP additions that may have occurred from amalgamation with another entity. G is the eligible dividends that have been paid out in the prior year. So we total all of those 5 components up, C to G, which will give the total of what A will be. B is the general rate factor times any current year losses carried back. I'm going to shoot over to IVPO where I will show you an example. Alright, let's look at this scenario here. We have active business income of $2 million, aggregate investment income of $150,000, eligible dividend received of $75,000, and a taxable capital loss of $20,000, noting that the full capital loss would have been $40,000. We only recognize 50%. The GRIP at the year end 2020 is $300,000, and an eligible dividend was paid of $280,000 in the prior year. Now, we've got to fill this out. So let's look at what we're going to start with. We're going to ignore A and B because they are our starting components. Let's look at C. C is the GRIP for the year ended 2020. $300,000. D is going to be the general rate factor times the taxable income. The general rate factor is 72%. And then we've got $2 million minus off the small business deduction of $500,000, in which we're assuming that this corporation will get the full amount. So ABI minus small business deduction is going to give us this figure here. The next part is add on any eligible dividends received, $75,000. Do we have any adjustments to GRIP from amalgamations? We do not. And then we got to minus off the eligible dividends paid out in the prior year. Remembering that the calculation for A is going to be C plus D plus E plus F minus G. So let's add all of this up. 300,000 plus, we get our trusty calculator right here. 0.72 times 2 million. Looks good. Minus our full small business deduction equals $1,080,000. We're going to add on our eligible dividends received. There's going to be no GRIP adjustment. Running out of room here. We minus off our prior year eligible dividends declared. So we're going to have 300,000 plus plus $1,080,000, and that looks good there. Plus $75,000 plus null minus off 280,000 to give us A equaling $1,175,000. B is going to be the general rate factor times we don't need it in negatives. The general rate factor of 72% times the capital loss, the taxable capital loss of $20,000, which is going to be $14,400. A minus B equals a GRIP at the end of the period of $1,160,600, $1,160,600, in which we can designate as eligible dividends to the shareholders. There's another tax account we need to worry about, and that is the low rate income pool, or LRIP. Non-CCPCs don't need a GRIP account. They do not get a small business deduction, so all of their dividends will be eligible. However, if they had moved on from a CCPC, they may have some income that has been taxed using the small business deduction, or they may have received non-eligible dividends. The formula for calculating the LRIP account was the following. See section 89.1 for the extended formula. It is the LRIP of the prior year plus the non-eligible dividends received plus any LRIP that is added on from either ceasing to be a CCPC or amalgamation minus any non-eligible dividends declared. When you are changing a status from being a CCPC, where you're ceasing, or you're becoming a CCPC, similar to that when you are completing an amalgamation, you must deem a year end. And this is in order to close off any accounts and define what your tax liability is under a CCPC and find what your retained earnings are with your financials. So you wanted to figure out what your GRIP is and your LRIP is as well. What can happen when you're designating dividends and you have some eligible dividends, you have some GRIP, is you may have an excess of eligible dividends declared. This does attract Part 3 tax, and the penalties are not friendly. We need to determine what the excess is. If you are a CCPC, the calculation is the following. It's going to be A minus B times C divided by A, which will determine what your excess is. If you look under subsection 89 part 1, you're going to find this formula. The first part is, which is a total dividends paid. This is the total dividends that have been, total eligible dividends that have been paid to the shareholder, not just declared, minus the greater of nil or the GRIP at the year end. You're going to times this by the eligible dividends declared divided by the total eligible dividends paid. If you are a non-CCPC, you're going to have to worry about LRIP. When you make the election to not be a CCPC and you may have an LRIP balance, you need to declare these non-eligible for dividends before you declare any eligible dividends. If you make a mistake on this, the calculation is as follows. A times B divided by C. A is the lesser of total eligible dividends paid or the LRIP balance. You will times this by the eligible dividends declared divided by the total eligible dividends paid. Whatever figure you come up with, you will get a penalty under Part 3 tax of 20%. You can avoid this penalty if you've made this mistake by making an election under Section 185.1 Part 2 to treat the excess as a non-eligible dividend. This must be done within 90 days of the assessment. However, going on from this, if you meet the definition of an excessive eligible dividend designation, see again Section 89 Part 1, this is when the eligible dividends are paid and the calculation for the transaction of GRIP has been done to artificially maintain or increase GRIP, or to artificially maintain or decrease LRIP, then this is seen as a tax avoidance and is defined as an excessive eligible dividend designation, and an extra 10% will be applied. This will mean the total penalty will be 30%. But wait, it gets worse. You don't have to do this calculation that we did in the prior slide trying to figure out what the excess is. The 30% penalty will be based on the entire eligible dividend that was declared. This is a strict anti-avoidance provision in order to reduce corporations from manipulating or gaming their GRIP or LRIP accounts to distribute further eligible dividends. All right, that's all for now. Please join me for Module 8, where I'm going to be talking about compliance. Yes, we're going to be talking about penalties and interest for the many tax returns that are filed late, and the many millions of dollars of taxes that are paid late. Thank you.